Welcome back, curious minds. We're diving deep today into E2open's fiscal first quarter and their full year 2026 results.
Yeah, and this wasn't just any earnings call, was it?
No, definitely not. It was really shaped by this massive corporate event happening in the background, the pending acquisition by YSEC Global.
Exactly. And what makes this call so interesting is how E2open's management presented everything, their performance, their outlook, while basically sitting on the edge of this huge deal.
Right. It gives you a unique look at how companies handle messaging during these, pivotal moments.
For sure.
So for you, our listener, the mission today is to cut through the noise, unpack this call, and figure out the crucial insights. What's really going on at E2open, and what does this deal mean for the whole supply chain software world?
Let's get into it.
All right, let's kick things off with a snapshot. E2open's fiscal Q1 2026 performance. Are we actually seeing signs of that turnaround management's been sort of hinting at?
We absolutely are, I think. The standout figure here really is subscription revenue. It hit $132.9 million. Okay. Which actually sailed past the high end of their own guidance range of $129 to $132 million. So, strong start.
That is strong. And this next number really jumped out at me. Year-over-year growth of 1.1% reported.
Mm-hmm.
And even on a constant currency basis, taking out the exchange rate fluctuations, still positive growth, 0.9%.
Yeah.
And this marks the first year-over-year growth in subscription revenue since, mid-fiscal 2024? That feels pretty significant for a software company.
It's certainly a signal, isn't it? And total revenue also moved up 1.0% year-over-year, landing at $152.6 million.
Okay.
And profitability-wise, adjusted EBITDA, that key measure, stripping out some non-cash stuff, landed strong at $52.2 million.
Right.
That translates to a pretty healthy 34.2% margin. Definitely shows improved efficiency compared to last year.
But maybe the biggest turnaround part of the story, in these numbers anyway, is that net loss. Big improvement.
Huge improvement.
A net loss of $15.5 million this quarter. Compare that to, $42.8 million loss same time last year?
Yeah, quite a swing.
Fewer red numbers. Always a good sign for investors, wouldn't you say?
Definitely. It shows that, their internal efforts to tighten things up, improve the core business, are actually starting to pay off, even before this YSEC deal closes.
Okay, so those top-line numbers are promising. But as we know from digging into these calls, the real story is often, buried in the details.
Let's peel back the layers a bit. The financials. And what did management really emphasize was driving these changes?
Well, what's really insightful here is how management explained that return to subscription revenue growth. They didn't just say things are better.
Right.
They directly tied it to improved client retention and stronger bookings performance, especially building on momentum they apparently saw in the back half of FY25.
Okay, so retention and bookings, that suggests maybe a more fundamental shift in how they're managing customer relationships, not just chasing new logos.
That's how it sounds. Yeah, moving beyond just new sales, more foundational.
And professional services revenue, that's pretty flat, right? $19.7 million. Yeah, basically flat year over year. Management kind of hinted at potential growth later in the year, but the fact that it's stable now is seen as, a positive.
What does that stability tell us, though?
Well, it suggests, I suppose, that their existing projects are on track. It's not a growth driver right now, but crucially, it's not a drag either.
Gotcha.
On gross profit, non-GAAP gross profit was $102.4 million. That's actually a slight dip year over year.
Oh, okay.
And the gross margin dipped too, from 67.8% down to 67.1%. But management was quick to point out.
Oh, okay. There's the explanation.
Yeah, they said this dip was mainly because of lower professional services gross margin, which they do expect to improve later.
Okay, makes sense. And how did they pull off boosting those EBITDA margins and slashing the net loss so dramatically? What specific operational discipline did they highlight?
They talked about ongoing cost discipline, specifically in non-client facing areas.
Right, the back office stuff.
Exactly. And also optimizing their offshore R&D resources. This kind of laser focus on efficiency is just crucial for sustaining growth, especially when a company's repositioning itself or, like here, going through a massive acquisition.
And the cash flow picture sounded strong. Always a good indicator.
Very strong, actually. Adjusted operating cash flow was $48.0 million. They said it was driven by really robust customer collections and just efficient working capital management.
Nice.
They ended the quarter with $230.2 million in cash. That's up $33 million just from the prior quarter. So excellent cash generation.
That's key liquidity heading into the acquisition for sure.
Absolutely.
Now, beyond just the numbers, the CEO, Andrew Appel, he spent a fair bit of time framing the last, year and a half. What was the core message there about their strategic focus?
Yeah, his main point was really about building a solid foundation, operationally, culturally, to get back to organic growth. And the core principle, he said, was pretty simple. Just delighting customers, making sure they get distinctive value. They seem to really believe this customer-centric thing is the engine for long-term growth, for staying competitive.
And they tried to back that up with actual improvements, right? Like client retention.
Yes, exactly. They emphasize that client retention is way up because they've been prioritizing long-term partnerships over just, short-term wins. And they've also been busy on the product side. Continued R&D investment. They mentioned some new tools like supply network discovery, helps companies map out their whole supplier network.
Interesting.
And also generative AI tools that are making their transportation management and global trade stuff apparently smarter, more efficient. And they hinted more product announcements are coming.
It really sounds like they're going out of their way to hammer home the point that the core business is robust, it's improving, even with this massive YSEC deal happening.
Totally.
It's like they want everyone to know this isn't a rescue situation. This is a company ready to accelerate.
Precisely. They kept reiterating that their platform does mission-critical supply chain functions for, Fortune 1000 companies, and that they're still winning new strategic customers, expanding with existing ones.
Right.
They basically said their client list is their most valuable asset. That's underpinning that robust core you mentioned.
Okay, so taking all that in, what does it mean for the full year? Especially if this huge acquisition just, looming.
Yeah, that's the big question, right? And it was a key point on the call. Because of the pending YSEC deal, E2open will not be doing a live Q&A.
Ah, okay. No Q&A.
No Q&A, and no new quarterly guidance going forward for now. They only reviewed their full year fiscal 2026 guidance. And importantly, they confirmed all aspects of it, the guidance they already gave back on April 29th.
So they're sticking to their guns.
Yeah, it tells us they feel confident enough, I guess, that nothing in this quarter changed their view of the full year.
Okay, so no new full year numbers, but a confirmation of the old ones. Remind us, what were those confirmed figures?
Okay, so for the full fiscal year 26, still expecting subscription revenue between $525 and $535 million.
Right.
Which represents year-over-year growth of basically anywhere from -1% to +1%. So roughly flat, plus or minus.
Okay. And total revenue?
Total revenue expected between $600 and $618 million. Again, pretty similar growth rate range, -1.3% to +1.7%. And gross profit margin projected between 68% and 68.5%.
Got it. And the outlook for profitability? Cash flow. Still holding?
Yep, still holding. Adjusted EBITDA expected in the range of $200 to $210 million. That implies a margin of around 33% to 34%.
Yeah, okay.
Adjusted operating cash flow as a percentage of that EBITDA expected roughly in line with last year, FY25. And their net leverage ratio of, compared to earnings projected around 3.88 times at year end. That's a number people will definitely watch.
For sure. Okay. The elephant in the room then.
Yeah.
This YSEC Global acquisition, the CEO spent quite a bit of time on it. What's the strategic rationale here beyond just getting bigger? What's the real synergy they're selling?
Yeah. Well, connecting it to the bigger picture, the CEO sounded genuinely excited, called YSEC an ideal partner. I mean, both companies are recognized leaders in supply chain and logistics software, right? But YSEC's traditional focus, more international freight forwarding, logistics execution, E2open brings this really broad suite. Planning, channel management, supply applications.
Ah, so it's about filling gaps for each other.
Yeah.
Creating that one-stop shop.
Exactly. That seems to be the core idea. The combination extends YSEC's reach, adds E2open's complementary stuff in domestic logistics, carrier integration, global trade, things YSEC didn't have as strongly.
Right.
The vision they're painting is this new combined company will be uniquely positioned to serve, a much broader set of clients across the entire value chain, from sourcing all the way to fulfillment.
They want to be indispensable.
That's the goal. They're aiming high.
And it wasn't just about the tech, right? The CEO made a point about the people too.
Yeah, that was a crucial point he made. He emphasized YSEC is acquiring E2open, not just for the software in the network, but also for its, quote, deep base of knowledgeable and highly experienced employees.
Right.
And its uniquely valuable customer base. The ultimate goal, he said, is for the combined entity to become the operating system for global supply chains.
Wow. Operating system for global supply chains. That's ambitious.
Very ambitious. It'll be fascinating to see if they can actually unify what's, let's face it, a pretty complex and fragmented market.
Definitely. So what's the timeline look like for this deal, and what does it mean day to day until then?
Well, the process for all the required filings, U.S. regulatory approval, that's apparently underway and on schedule. They expect the transaction to close by the end of this calendar year.
Okay, so sometime in the next 6 months or so.
Yeah. And until then, both E2open and YSEC Global just continue to operate as totally independent companies. So it's kind of a waiting game, but one that seems to be moving along smoothly.
Okay, we've covered the facts, what management said. Now let's have a little fun, maybe a thought experiment.
Right.
But first, the important reminder. Everything we're about to discuss now is purely for informational, maybe entertainment purposes. It is absolutely not financial advice.
Definitely not.
Always do your own homework, your own due diligence, and please, please consult a professional before making any investment decisions.
Okay, absolutely. Disclaimer delivered. So with that out of the way, let's put on our imaginary hedge fund analyst hats for a second.
Okay, I'm ready.
Given E2open's return to subscription growth, that confirmed guidance, and this massive YSEC deal, here's an outrageous but maybe plausible trade idea to chew on.
Lay it on us.
Okay, the core thesis. The market right now is maybe underappreciating the synergistic value. The potential market dominance of this combined E2open YSEC entity, that whole operating system for global supply chains narrative, it's powerful. And maybe, just maybe, the lack of Q&A, the lack of new quarterly guidance because of the deal, maybe that's creating a temporary information vacuum, leading to a bit of a discount.
Interesting angle. So what's the play?
So the thought experiment, the play. Imagine taking a long position in E2open, betting on its future as part of this combined beast.
Right.
And then pairing that with a short position on a smaller, maybe more specialized, less integrated supply chain software player. One that focuses purely on, say, international freight forwarding.
Ooh, okay. The logic.
The logic is this. As the combined E2open YSEC giant solidifies that operating system story, integrates E2open's broader suite, it could potentially start pulling significant market share from those niche players, the ones who just don't have the end-to-end capability or the global reach.
Because YSEC isn't just international freight anymore with E2open.
Exactly. With E2open, they suddenly have domestic logistics, planning, global trade. It's a comprehensive solution now. And the fact that E2open's underlying business seems to be strengthening before the integration even kicks in, that only adds fuel to this idea.
So the trade is basically betting on consolidation.
Yeah.
And that the combined entity captures premium value while the niche player feels the squeeze.
Pretty much. Betting on the market, eventually recognizing this combined power, valuing the new entity at a premium, while that less diversified competitor faces, increased pressure. Plausible? Maybe. Outrageous. Definitely a bit.
Food for thought, definitely. Okay, so let's recap this deep dive then. E2open Q1 FY26 showcased a notable return to subscription revenue growth.
Yep, first time in a while.
And significant improvement in the net loss. Full year guidance confirmed, signaling stability, even with this major corporate transformation on the horizon.
And the dominant theme, of course, looming over everything is that pending acquisition by YSEC Global, positioned as this really strategic move to create a formidable operating system for global supply chains, combining their complementary strengths, logistics, planning, trade apps.
And the emphasis on both the tech and the people, the employees, the customers, highlights that long-term vision for market leadership.
For sure. The implications really are pretty significant for the whole supply chain software industry. We'll definitely be watching closely to see how this combined entity actually executes on that really ambitious vision.
Yeah, becoming that operating system. So what stands out most to you from this call? And thinking ahead, how do you think this mega merger might actually reshape the competitive landscape?
Well, it leaves you wondering, doesn't it? Will the smaller, more specialized players, will they be forced to consolidate themselves? Or maybe they'll find new unserved niches in the shadow of this new giant.
Interesting question.
That's something worth exploring, I think, as the dust settles on this deal.
Indeed it is. And with that final thought, another deep dive concludes. Thanks for joining us.